Hello friends, good evening to all of you, and it's about the VAR we are going to learn about and also about the duration. So first of all, let's discuss about the VAR. VAR is what? VAR is the value at risk. VAR is the value at risk. Now VAR tells you about the that if the adverse movement is there under the normal scenarios, under the normal scenario, the maximum expected loss it will be telling you about with the possibility over the given time horizon. Let's say the confidence limit is given to be, or we say to be CL, it is given to be 95%, and it is given for the time horizon of 10 days, right? And the VAR is given to be 12,000. What does this indicate? This indicates that for the 95% of the probability under the normal circumstances over the time horizon of 10 days, the maximum loss would be limited to 12,000 rupees under the normal circumstances for the 95% of the possibility or probability, we can say. And only 5% chances are there that the losses will go beyond 12,000 rupees. Only 5% chances are there that the losses will go beyond 95% or let's say above 12,000. So VAR, that is a value at risk, this is a maximum expected loss over a specified time horizon, right? At a given confidence level under the normal market conditions. We are covering the normal market conditions only under the VAR and not the abnormal market conditions. Clear with it? So that's about the VAR, and we are having the multiple approaches for the VAR. So there are key components of the VAR. What are the key components? The one, it is related to the time horizon. Kindly please take a note. The key component, the one key component is it's about the time horizon, like the period we are talking about. Like in this case, we have taken 10 days. The second thing, it's about the confidence limit. We say it to be CL, like the probability level. And the third one, it's about the loss estimate which is given to you, right? Clear with it? So here is an example which is given to you. So the override VAR is 45 BPS, 45 basis points, means 0.45 percentage. Confidence level is given to be 95%. So there is only 5% possibility, only 5% possibility that the loss will exceed 45 basis points per USD to dollar. And 95% certainty is there that your loss will remain within the limit of 0.45, right? So if the spot rate is given to be 46, if the spot rate is given to be 46, and it means 46 minus 0.45, that is equal to 45.55. Only 5% chances are there that your prices will go below 45.55, and at other times it will be above 45.55 only, right? That's about the VAR. And basically it's a statistical thing. VAR is what? VAR is a statistical measure. It's written over here in the very starting. It's a statistical measure. We use the different statistical techniques for the same, right? And higher the VAR, sorry, higher the volatility. If the volatility is higher the volatility, it means higher the VAR. It means higher the VAR. And higher the VAR or higher the volatility means higher the risk. So it interprets in this sense. So higher the VAR is higher the volatility, or higher the volatility is higher the risk. Clear with it? And we are having the multiple approaches so as to calculate the VAR. The first one, it's about the parametric approach. The first approach which is there so as to calculate the VAR, it's a parametric approach. We say this to be the variance-covariance method. We say to be the variance-covariance method. Parametric approach. Now, it's basically based on the sensitivity of the risk factors. Like will be looking into interest rate changes, exchange rate movements, market index changes, right? So we have to use the mathematical formula for this. We have to use a mathematical formula for this. And this is basically useful for the quick estimation purposes. For the linear portfolio, this is useful, the parametric approach, right? So it is based on the sensitivity of the various risk parameters. So we'll be not be just looking into one parameter, we'll be looking into the sensitivity of the multiple risk parameters, right? And for the based upon that, we have to calculate the VAR. The second method that is being used is a Monte Carlo simulation. The second method which is being used is a Monte Carlo simulation. Now, what do you mean by Monte Carlo simulation? Now, there are multiple scenarios. There will be like multiple random simulations will be there. Like the thousands of scenarios will be there, right? And based on those scenarios, we are going to estimate it. We are going to estimate it. So the Monte Carlo simulation method is a quantitative risk analysis technique. It is what? It is a quantitative risk analysis technique, right? So you'll be identifying the multiple variables like interest rate, exchange rate, etc. You'll be assigning the probability distribution toward it, like normal probability distribution, uniform probability distribution, something. And based upon that, we are to generate random of the values. Like let's say using the computer, we are generating thousands and tens and thousands of the iterations. Then we'll be running the simulations on those particular estimates, and then we'll be looking for the results, the average outcome, right? So that's the Monte Carlo simulation. And what is the worst part about the Monte Carlo simulation? Like we are to judge the values, right? So definitely the biasness could be there because we are taking the multiple scenarios, and those are the random scenarios. Those must not be the plausible scenarios, right? So that's the case. And the third one, it's about the historical data approach. It's about the third one, it's about the historical data approach or historical simulation approach. So now in this approach, we have to use the past market data. We have to use a past market data, past data that we need to use. So we are assuming that the history repeats, right? So we have to take the historical price changes. We'll be applying those changes to the current portfolio, and we'll be identifying the worst losses based on that. It is simple because there is no distribution assumption in this scenario, right? Clear with it? And further after that, the next one, it's about the duration. The next topic, it's about the duration. What do you mean by duration? What do you mean by duration? Now, like duration is a time rate. Simple sense if we're talking about now. Let's say in the case when the interest rate risk is there. Which risk is there? Interest rate risk, which is a type of the market risk, right? So the interest rate risk is there, which is going to impact your portfolio. Let's say we're talking about the bonds, right? Now the interest rate is going to change. Definitely your earnings will alter. Definitely your the bond value will be changing because there is inverse relationship between the interest rates and the bond prices. When the interest rate increases, the bond prices does decrease, right? Because there is a sensitivity of the bond prices toward the interest rate change. So duration is representing the time period for which if we are holding the bond, the interest rate risk will become zero. The interest rate risk will become zero. So interest rate risk is going to be neutralized, right? And further, after this period, the reinvestment risk and the price risk are going to offset each other. They're going to offset each other. That's about it. So if we are to learn the concept about the duration, there is simple thing that you should be, first of all, considering. There is a very simple point that we are to understand. That's about the duration measures the interest rate risk of a bond. Duration measures what? Duration measures the interest rate risk of the bond, and interest rate change. If the interest rate change, then how much the bond price will change. That's basically what, that's about the duration. Because I already told you that there is inverse relationship between the bond price and the interest rates. So the duration tells the sensitivity of the bond price to the interest rate changes, right? So higher the duration means higher the risk. So let me write over here. So if you're having the higher duration, it basically interprets the risk is also higher, and lower duration means lower the risk, right? And it is expressed in years. It is expressed in years. And there is a simple formula because the concept was first of all developed by the Macaulay. That's why it is said to be the Macaulay duration. And the formula is very simple. Like it is summation of PVT divided by the PV. PV is the present value of the bond. Like you are having the, let's say this is the timeline of the bond. 0, 1, 2, 3, 4, and 5. Let's say we are considering 5-year bond, and the face value of the bond is given to be rupees 1000, and you are earning a coupon of 8%. Coupon means the periodic interest payment that you will be receiving. So 8% of 1000, that is 80 rupees per year that you will be earning. And at the end of the tenor, 5 years, you will be getting the face value of the bond also, that is rupees 1000 also. So now you are to basically convert these values into present values, and that present value can be calculating at the using the discount rate. Using the discount rate, you can be calculating the present value, right? So let's say we are considering the required rate of return, or let's say we are considering the YTM to be 6%. So using the discounting factor formula, the discounting factor formula is 1 divided by 1 plus R raised to power n. So the first year, so for the first year, the discounting factor would be equal to, if we are considering ROR, required rate of return, that is a market return, to be 6% lower than the coupon rate, then the discounting factor would be equal to 1 divided by 1 plus R. We will be converting 6% to the decimal part, that is 1.06 raised to power 1, right? And if we simply calculate the 1.06, 1 divided by 1.06, it comes out to be 0.94. 0.94339. This is a discounting factor for the first year. Now, if we multiply the discounting factor value to the cash flow value, we'll be getting the present value. So for the first year, it is 0.9433 multiplied by 80. That was a cash flow for the first year, right? So it is coming out to be 75.47. This is a present value of the first year cash flow. For the first year cash flow, it is 75.47. Similarly, we can be calculating it for the multiple years, for the second year, third year, fourth year, and fifth year, right? Then we have to calculate the present value. So this formula, under this formula, if we look at the denominator, this is basically summation of all the present values. This is a sum of all the present values, right? And in the numerator, we're having the multiple product of the present value with the time factor. Like for the first year, it is 1. For the second year, it is 2. For the third year, it is 3 and 4 and 5, like this. So we'll be multiplying the present value with the time factor, and then we'll be having the sum of all. That's the numerator. And this is a formula related to it. So T is the time period over here. The T over here, this is the time period. This is a time period. And PV is representing what? PV is representing the present value of the cash flow. Present value of cash flow here. Getting it? Now let's have a look at the properties of the duration. Properties of the duration. So duration is always lesser than the maturity of the bond. Is always lesser than the term to maturity. And it's only the zero coupon bond where you are not getting any of the coupons. Right? In case of zero coupon bond only, the duration is equal to maturity. The duration is equal to maturity. Right? And for the perpetual bonds, for the perpetual bonds, like the perpetual bonds are those bonds which are not going to have any maturity. You're just going to receive the coupon for the lifetime purpose. There the duration is equal to 1 plus r divided by r. In that scenario, the duration is equal to the formula, the traditional formula would not be applicable. It is 1 plus r divided by r, right? Where r is the current yield of the bond. R is what? R is representing not the discount rate here. It is the current yield of the bond. In case of the perpetual bond I'm talking about. And further, longer the maturity, higher the duration gap would be there. Like longer a coupon paying bonds term to maturity, greater is the difference between its term to maturity and the duration, right? So higher duration gap will be there, longer the maturity is there. And further, it is inversely related with the YTM. So more is a YTM, lesser is the duration. Lesser is a YTM, more is the duration, right? And more is the duration means more risky it is. And let's say larger is the coupon rate, smaller is the duration of the bond. So higher is the coupon, that the interest that you're getting, right? Lower is the duration of the bond, right? And further, more is the frequency of the coupon. Let's say if you're getting the coupon annually and you are getting the coupon quarterly, in case when you are getting the coupon quarterly, the duration will be lesser in that case. And in case when you are getting the coupon monthly, even if all the other things are all same, the coupon rate is all same, the market rates are all same, but you are getting a coupon monthly in one case and quarterly in another case. So in case when you're getting the coupon monthly, the duration will be lesser in that scenario. And also the duration of the bond declines when the bond approaches the maturity. When the bond approaches a maturity. So duration is what? This is a weighted average recovery period of investment. Weighted average recovery period of investment. The duration is, it is expressed in years. Higher the duration, higher the interest rate risk. Lower the duration means lower the interest rate risk is there. Right? So do like the video and further share the video at the earliest, and simply just do write CAIIB. If you want to get the complete pack, complete course related to all the 5 papers of the CAIIB, just simply do WhatsApp CAIIB and WhatsApp it to the number 83609 I'll be sharing the complete details to you, like, and you'll be getting the full course videos, chapter wise previous year questions, mock test, mega test, PDF notes, each and everything. The case study videos will also be covered, right? So that will be all. Thank you so much and see you again in the next video.